welcome to the new edition of the International Lending webinar. It's a great honor and privilege to welcome Hanno Lustig from Stanford University to join us today. He will present exciting new work on the international or the exorbitant privilege and the fiscal implications of us. I really look forward to seeing the paper. I guess Hanno needs little introduction. He's one of the most well-known macro finance researchers, has wrote a broad range of issues, including, of course, the work I know best on international finance, and that maybe you also know best. Yeah, it's wonderful to have him here. He has been at Stanford for quite a while, and I realize he also graduated there with stints between in Chicago and UCLA. So yeah, thanks a lot for taking your time for presenting this work from kind of where we discussed about this, trying to push the frontier of the field. And yeah, thanks a lot. So we look forward to seeing your talk. The floor is yours.
Okay, great. Well, thanks a lot for extending this invitation. Really excited to get this opportunity to present my work. I'm going to share my screen here. So is this, can you all see my slides now? Okay, great. So thank you, Christoph. Very excited to be talking about this work. It's actually not that hard to motivate this paper. As you know, there is a debate ongoing right now in the US about fiscal sustainability. The US federal government dramatically increased spending during the pandemic, spent about an additional 20% of GDP during the pandemic. So that was a big effort, a big lift. The federal government's debt to GDP ratio is now well above 100%, which is roughly where it was at the end of the Second World War. So that is sort of uncharted territory for the US. And then the question, of course, is how much extra fiscal capacity does the US have? I think during the pandemic, it's fair to say that there was sort of a broad consensus that the US had lots of extra fiscal capacity as we have come out of the pandemic, as central banks have started quantitatively tightening. What we've noticed is that real interest rates have gone up dramatically, and so we now see a reassessment of this question, and some people are wondering whether perhaps the US has used up much of its fiscal capacity. So there's an interesting debate there. That's sort of the broad context for this paper. Interesting. There was a column on August 4th that Paul Krugman wrote, which got quite a bit of attention, where he actually did sort of what we're going to do, look back at history to get some guidance, which I think is a natural thing to do. And the natural country to look at is the UK, because you could argue that the UK was exactly in a position last century, that is, where the US is right now. The UK was the world's financial center, and it benefited from what we've now come to call this exorbitant privilege, generating fairly inelastic demand for its IOUs. And so what we're going to do is look back and try and learn from history, and particularly look at the case of the UK. And then towards the end of the talk, I'm going to switch gears and hop across the channel and actually look at the experience of the Dutch Republic, which I think is also going to be informative with regards to this question. So the title of the paper is Exorbitant Privilege, Gained and Lost, Fiscal Implications. This is joint work with a team of authors that I've had the privilege of working with on related topics. Of Chen, who's in Peking, Zhengyang, who was my student here at Stanford and is now at Northwestern, Stijn van Nieuwerburgh, I've been working with him for quite a while now, and Mindy, who was my student at UCLA and is now at UT Austin. So that's the team of authors. And let me try and yes,
what I forgot to mention as a moderator, I should say that you have about 45 minutes, and people can, Hanno agreed that people can actually jump in to ask questions. Yes. So this is kind of an open seminar, either via the chat or even by talking up. So just to say that this is kind of open for discussion for everybody. Thanks.
Yeah, thanks for pointing that out, Christoph. So 45 minutes, got it. So I'll try and stay on time there, and you should cut me off if I don't. So let me start by actually using this quote, which I think is really quite appropriate. It's a quote from a paper by Gorin-Chasbre and Sauzet, where they say, well, being the hegemon in the international financial system, that is, confers specific ability to issue large amounts of nominally safe liabilities, which are happily absorbed by the rest of the world, right? So there's this idea of inelastic demand, and for IOUs issued by, in this case, the US Treasury. And that's a key component of exorbitant privilege, right? The idea being these IOUs play a critical role in the international financial system. They're sort of viewed as intrinsically safe, and that generates this inelastic demand. Now, of course, that raises the question, well, when do you sort of exhaust this exorbitant privilege, right? And that brings us back to the question I raised at the beginning about fiscal sustainability, and that's what our paper is going to look at. We're going to study 3 centuries, really, of fiscal history, estimate the fiscal backing of debt issued by the Dutch Republic in the 17th and 18th century, the UK in the 19th and the 20th century, and the US. And we're going to try and learn from that. And so the key finding is, well, first of all, there seems to be this pattern of having one key player in the international financial system who sort of has a monopoly on the provision of safe assets. We're not the first to point that out, obviously. That's sort of a key stylized fact. But what we find is that when a country plays this role, it really has this ability to issue debt at lower yields than other countries, at much lower yields, that is. And we're going to take all that into account and do a serious quantitative exercise where we account for these, what I would call convenience yields, that is the ability to issue debt at lower yields than others. And what we find is that even when we account for these convenience yields, we find that the hegemon, the safe asset supplier in the world, whoever that may be at a given point in time, has an ability to issue more debt than what's warranted by fundamentals, accounting for the convenience yields as well. So that's a key finding. But then once your relative macro fundamentals deteriorate enough, and I'll give you examples of this both in the case of the UK and the Dutch Republic, this extra fiscal capacity is withdrawn. And that could make for sort of an abrupt and painful transition. So that's the exercise that we're going to look at. Let me sort of give you a little bit of background on the UK in the 19th century first, just to set the stage. As you probably know, London became the world's financial center in the 19th century, and gilts were really important. They accounted for over half of the market cap of the world's traded securities, according to some sources, and they traded at much lower yields than other bonds. In fact, there's a very nice paper by George Hall, Jonathan Payne, Tom Sargent, and their co-author, where they sort of quote Hamilton, who, as you know, was in charge at the Treasury in the US, and he was extremely frustrated about this because the UK had issued a lot more debt than the US. Of course, the US was a young republic, and Hamilton was frustrated about this and sort of carefully thought about how the US could try to sort of emulate what the UK was able to do in terms of harvesting these convenience yields. So it's interesting to see that Hamilton was actively thinking about that even then. What we find is that in the 2 centuries before the First World War, roughly 75% of UK debt was actually backed by surpluses. So they were able to issue more debt than what was warranted by fundamentals. And then there's a dramatic shift during the interbellum between the First and the Second World War, As you probably know, at the start of the First World War, the UK abandoned the gold standard. So did France, Germany, and other participants in the First World War, by the way. The UK then made an attempt to return to the gold standard in 1925. And actually, if you read Churchill's biography, you'll see that he describes that as one of the worst decisions he made in his career. He decided to return the pound to its pre-war parity, which in retrospect was probably not a wise decision. They permanently abandoned the gold standard in 1931. The UK was in fiscal trouble during the antebellum. There's really no question about that. You could describe it as a regime of financial repression. There was restructuring of UK loans in the following sense. So first of all, in the 1930s, the UK essentially defaulted on all the loans it had taken out from the US. These were war loans, which it had stopped making payments on, and then eventually it stopped repayment altogether. And then there was another instance of a large issue of a bond issued in the First World War, a 5% coupon bond that was converted into a 3.5% coupon bond, which some would call sort of akin to restructuring of debt. But the most notable thing is that gilts then started trading at much higher yields. And the UK yielded sort of this leading position to the US, no longer the hegemon. UK debt no longer earned convenience yields. And what I'll show you is that since the Second World War, the UK's debt has essentially been fully backed by surpluses. I'm going to contrast the UK experience with the US experience. Before the First World War, as I mentioned before, when I was citing Hamilton, the US had to finance its debt, the federal government that is, at a much higher yield than other countries, even though there was much less of it. We find that in our calculation, as I'll show you in a little bit, that the US government debt was more than fully backed by surpluses before the First World War. And after the Second World War, this changes dramatically. The US earns large convenience yields relative to other bonds, and the market value of its debt exceeds its fiscal backing consistently. That's not surprising, that last finding, because the US essentially has not been running primary surpluses since the Second World War. So that shouldn't come as a big surprise. Okay. Before I jump into the paper, let me sort of give you the lay of the land. We're obviously going to make contact with large literature on fiscal capacity of governments. That's the literature that our paper tries to contribute to, but specifically focusing in on the US's role as the world's safe asset supplier. And we want to try and understand, well, how does that affect the fiscal capacity of the US government? This is obviously also linked to the special role of the dollar as a reserve currency. There's a huge literature on that. More generally, there's this notion that treasuries are special. There's this interesting finding in finance that if you compare treasuries to other securities, you'll find that they're expensive. Let me give you an example. If you take, for example, a German government bond and you add currency insurance, you hedge the currency risk, create a synthetic US treasury, that is going to be typically cheap relative to a real treasury. And that's sort of a consistent finding. You can take bonds from any other country. You can add credit risk insurance if you want to. You'll typically get that finding. Treasuries are expensive, and we're going to take that into account when we compute the fiscal capacity of the government. Okay, let me jump right into it and give you a little bit of an overview. Obviously, a lot happened in the 19th century in UK history, but a little bit of an overview of the UK's fiscal history in the 19th century. So basically what you see is that the UK would typically issue debt to finance wars. That's basically the role of debt in the 19th century. The big one was obviously the Napoleonic War, and there you see a big run-up in the market value of debt to GDP for the UK, where it almost touches 200%. It comes back down. And then, of course, there's a big run-up in the First World War, where debt to GDP exceeds 100% again. And if you add non-marketable debt, these are the loans extended by the US to the UK that I was referring to earlier. Debt exceeds 150% of GDP. And then there's another big increase during the Second World War. What did fiscal policy look like from the perspective of surpluses? Well, what governments typically did before the First World War is whenever they went to war, they would finance part of it by raising some more tax revenue and part of it by issuing debt. Tom Sargent calls this the Barrow-Gallatin tax smoothing principle, and that's sort of roughly what you see when you look at the history of UK primary surpluses. Important to point out that they were consistently running large primary surpluses on average, but of course they're punctuated by these brief periods during which they run big deficits. Of course, the First and the Second World War are large outliers. On average, the primary surplus is 2.38% prior to the First World War. Okay. During the interbellum, what you see is sort of, as I mentioned earlier, a brief period of what I would call financial repression, very low real returns. To illustrate that, I've plotted the cumulative real return on all of the UK's debt. Importantly, it's real return, and what you see is that the cumulative real return goes down dramatically during the interbellum. Partly because of inflation in the immediate aftermath of the war, but also partly because the government was doing all sorts of things to allow itself to borrow at below market rates. Okay, before I jump into the actual quantitative exercise, let me give you a brief sense of what was happening in the US in the 19th century. Well, the US actually was not issuing a ton of debt. That's probably partly because they didn't have a lot of fiscal capacity to begin with. There's one exception in the 19th century, which is obviously the US Civil War in 1861. There you see a big run-up where, that's obviously because the Union had to finance the huge war effort, and they did resort to all sorts of tricks to make sure that they could fund the war at low yields, including, for example, setting up the national banking system and telling banks, well, you can issue greenbacks, but only if they're backed by treasuries. So making sure that there was sufficient demand for treasuries. Okay, so that's broadly speaking the broader context in the 19th century. That's what I'm going to focus on first, and then if time remains towards the end, I'm going to briefly tell you what's going on in the Dutch Republic. Now, you could sort of look at this picture right here and say, well, it sure looks like if you're the hegemon, you can issue tons of debt and it's sort of all worked out, right? That's not the message of the paper. In fact, I want to emphasize that during the interbellum, the UK was in serious fiscal trouble, and I'm also going to show you evidence that after the Second World War, its fiscal capacity was greatly reduced. So that's where we're going. And in order to do that, to make that point, I'm going to have to try and measure fiscal backing. So how are we going to do that? Well, this is where I'm going to have to put a couple of equations on the table, but this is hopefully going to be short and painless. As you know, if you look at a static version of the government budget constraint, what you have is you have the debt on the left-hand side here, D, that's the market value of all the outstanding securities. I'm going to work with zero coupon bonds here. So H denotes maturity. PTH is the price at time T of a security that pays off $1 H years from now, let's say 5 years from now. So that's the value of debt outstanding from last period. On the right-hand side, what you have is the primary surplus. That's the difference between the tax revenue that comes in and the spending, government spending. That's denoted G. And then you have new debt that's being issued to finance deficits. If you iterate forward on this constraint and you impose no arbitrage, that is, you impose that all these zero coupon bonds are priced properly using a pricing kernel denoted M, stochastic discount factor, then what you end up with is this very intuitive expression which says, well, it better be the case that the value of debt today is the properly present discount value of future primary surpluses up until some point cap t, let's say 100 years from now, plus the properly discounted value of debt outstanding 100 years from now. And we're going to define this as our measure of fiscal backing. We're going to push cap t out to infinity, impose a transversality condition or a no bubble condition. That is to say, we're going to assume that the present value of debt outstanding in the distant future goes to zero, and then we get this sort of intuitive expression which says fiscal backing is just the present discount value of the entire future stream. What does this expression for fiscal backing tell us? Well, let's sort of start by developing some intuition, looking at a steady state. In a steady state, fiscal backing scaled by GDP is going to be equal to tax revenue divided by GDP times this valuation ratio. What is that? Well, that's essentially the price difference ratio of a claim to tax revenue, right? If that claim was traded, this would be the valuation ratio it would be trading at. And then you look at the same thing for spending. That difference is fiscal backing. What goes into that ratio? Well, that valuation ratio is going to be governed by the short rate, Y0, 1, the yield spread, the difference between long yields and short yields. That's sort of the slope of the yield curve on average, and a risk premium, RP. And then on the other hand, you have X, the real growth of GDP, and inflation. Okay, so this is kind of an intuitive expression which says, well, the determinants of this valuation ratio are going to be primary surpluses. There's a discount rate component. The discount rate's determined by how high interest rates are and by how risky this cash flow is. And then there's a cash flow component, which is captured by the growth rate. Why the growth rate of GDP? Well, we're going to assume that taxes and spending are co-integrated with output. So they have to be growing at the same rate in the long run. Okay. Now, the key unknowns here are these risk premia on the claim to T and the claim to G. So here's how we're going to deal with this. We're going to argue that we can derive an upper bound. How do we do that? Well, we're going to say, look, at business cycle frequencies, it's pretty obvious that the tax claim is riskier than output, and output is riskier than the spending claim. Why is that? Well, because in bad times, high marginal utility states of the world, wars, recessions, the government is going to let tax revenue typically decline as a fraction of GDP, but it's going to spend more. Okay, so the spending claim is safe, but the tax claim is riskier. In the long run, all these claims are equally risky because spending and output are co-integrated with GDP. So what we're going to do is combining these two things. We're going to say, well, let's assume that taxes and spending are as risky as GDP. When we do that, we're going to be deriving an upper bound, right? Because we're picking sort of a discount rate that's too low for the tax claim, too high for the spending claim, and that gives you the result, trivially, that this is essentially an upper bound. And so then what you get is this intuitive expression that says fiscal backing is going to be bounded above by primary surpluses in the steady state, T minus G over Y, times the valuation ratio on a claim to GDP. Now, What determines the valuation ratio on a claim to GDP? You could think about that, by the way, as the valuation ratio of a basket of companies that don't have leverage. If you don't issue debt, the equity of unlevered companies would sort of roughly be akin to a claim to GDP. What does this valuation ratio mean? Well, it says, look, countries with higher GDP growth, lower real rates are going to have a higher valuation ratio and more fiscal capacity. That's, by the way, completely consistent with the way Olivier Blanchard thinks about this issue in his presidential address. But of course, what he doesn't think about, and what we want to focus on, is the risk component as well. So there's this RPY, that's the risk premium on a claim to GDP. And so if you turn on that risk premium, that reduces your fiscal capacity, obviously. And we're going to take that into account as well. Okay. Now, the key unknown here is RPY. What is the risk premium on a claim to GDP? As I said, we're going to argue that the claim to GDP is akin to unlevered equity, which I think is true in canonical asset pricing models, right? If you take a canonical consumption-based asset pricing model or run risk model, if you look at unlevered equity, that's a claim to GDP or a claim to consumption. That's basically the valuation ratio we're interested in. And we, looking at the historical evidence, are going to argue that, roughly speaking, a 3% risk premium seems reasonable there. That's the number we're going to use. We're going to use a constant risk premium there. We're going to tie our hands and then use that true number throughout. That's really sort of the one key unknown parameter. Obviously, if you lower that risk premium, you're going to increase fiscal capacity. And I'll walk you through the implications of that later on when we think about sort of robustness. Okay. Before we jump into the actual exercise, the last thing I want to mention is we're going to have to develop a measure of convenience yield. And ideally, what you want to do, this is what I've argued in some joint work with Zhengyang and Arvind, is you want to look at CIP violations in the government bond market, right? If there's a violation of covered interest rate parity, that's telltale evidence of a convenience yield. And so what we're going to do here, when looking at the historical evidence, is we're going to look at the gold standard period. We're going to assume that people think the gold standard is going to last forever. And then we're going to look at these yield differences between the US and a whole panel of other advanced economies during that period as a measure of the convenience yield. And so what you see is that prior to the First World War, both at the short end and the long end, there's a convenience yield of roughly 100 basis points. It's quite substantial, right? And that's sort of the direct footprint of exorbitant privilege, if you will. Okay. Now, by the way, you could say, well, maybe that difference reflects perceptions of credit risk. We can't really directly correct for that because obviously there are no CDS contracts being traded prior to the First World War. But what I can tell you is, by sort of leaving that out, we are in essence being conservative in our assessment, right? Because if we would make the convenience yield lower for the UK, that would reduce its fiscal capacity in our measurements prior to the First World War, and that's going to increase the gap, so to speak. Okay, so in some sense, and I'll come back to that, we're being conservative in our approach here. That's kind of the key takeaway. How do convenience yields enter into this fiscal backing measure, you might wonder? Well, you could think of them as sort of roughly increasing the surplus. So if lambda is a convenience yield, so suppose that the UK is able to borrow at a yield that's 100 basis points lower than the US, that's lambda. Well, that lambda generates seniorage revenue. It's akin to the seniorage revenue you get from money, right? Because you're able to issue securities at a lower yield than others. That's what this lambda captures. We multiply that by D in the future, the stock of outstanding debt, and that together gives you the total amount of seniorage revenue that the UK is extracting from its exorbitant privilege. And we're going to estimate that, obviously. On average, this is non-trivial. It's about 0.34% of GDP. So that's a big boost to its primary surplus. And we're going to take that into account when we do the numbers. Okay. So basically, where are we going? So let me give you first the steady state numbers. And then we're going to look at the dynamics, which is more fun. So prior to World War I, the first thing you need to know, well, what is the valuation ratio of a claim to GDP? And prior to World War I, it's roughly 21. The primary surplus is 2.38% of GDP. And then there's a convenience yield we plug in of roughly 70 basis points. If you add all of that up, you get a measure of fiscal backing relative to output of roughly 60% in the steady state, which means that roughly 70% of the debt is backed. So fiscal backing divided by debt is roughly 70% of GDP. If you run these numbers prior to World War II, in the right-hand side table, the numbers are pretty close, pretty similar, actually. Okay. Contrast that with the US. The US has a much higher valuation ratio for a claim to GDP, so that would increase its fiscal capacity. That's largely because the US was growing faster during the 19th century. But the US was running slightly smaller primary surpluses. And on average, its fiscal capacity divided by debt is roughly 170%. So the US was borrowing much less than what our measure of fiscal backing, the upper bound that is, dictates. So that kind of makes sense, right? Remember, our measure of fiscal backing is an upper bound. So debt should always be less than fiscal backing. That's the case for the US prior to World War I, but definitely not for the UK. The UK seems to comfortably exceed that. If you look at the dynamic estimate, which I'm showing you here, then, and by the way, this is sort of based off of a VAR estimate. Sorry, I went a little too fast here. I think I skipped a couple of slides. So this is what you get when you do the dynamics. So that was for the steady state. Now I do the dynamics. So the dynamics are going to be done by using a vector autoregression, where we have a state vector that includes inflation, short rate, yield spread, GDP growth, etc. We impose co-integration between spending, taxes, and output. And now we're going to recompute at every period in time this measure of fiscal backing, okay? So this is basically very similar to what you do if you take sort of a Campbell-Schiller approach to valuing a stock, and you use a vector autoregression. So if you do this dynamic exercise, then prior to World War I, on the left for the UK, what you see is that after the Napoleonic Wars, the market value of debt divided by GDP, plotted on the left-hand side in blue, comfortably exceeds the red line, which is our measure of fiscal backing. And that gap widens to well over 50% of GDP. The gap then narrows towards the end of the 19th century. On the right-hand side, you see the results for the US. Those results, in some sense, sort of conform with what theory would dictate, because there the market value of debt over GDP remains below what we think is the right upper bound, except briefly during the Civil War in the 1860s. So that's what you get prior to World War I. These are the numbers we were looking at before. What happens if you now fast forward to after the Second World War? Well, you see this big reversal. In the UK, what you see now is that debt is more than fully backed by fiscal backing. the UK is running large primary surpluses, and it's not issuing as much debt anymore. And in the US, you see a complete reversal. That's because the US is running essentially zero primary surpluses per post-World War II. Only 30% of US debt seems to be backed by primary surpluses. So that's kind of this picture right here. What you see here on the left-hand side is the picture for the UK. So the UK now looks like the US in the 19th century. Interestingly, it's lost its exorbitant privilege, and the market value of debt seems to stay below what we think is this upper bound, our measure thereof. On the right-hand side, you see the number for the US, and you see sort of the flip side of this, which is that now the market value of debt to GDP in the US is pretty much above this upper bound throughout the entire post Second World War period, but then of course punctuated by a dramatic gap in the last 20 years. Why is that? That's just because in the last 20 years, as you know, the US has been running large primary deficits. So those are the numbers for the US and the UK after the Second World War. Let me briefly, I think I have another 5 minutes or so, briefly talk about the Dutch experience in the 17th century. So this is kind of an interesting case. It would be a stretch to claim that the Dutch Republic was the world's safe asset supplier. That's really not true, but I think it is. It is a case, if you sort of read about the history of that time, that the Dutch Republic at least sort of had a local monopoly as a safe asset supplier. They were able to issue lots of debt, and in particular, they had a particular institutional structure. As you know, there were 7 provinces in the Dutch Republic. The borrowing was done by these provinces, and there were lots of institutional restrictions that made it credible for these provinces to promise to repay their loans. The Dutch back then were fighting the Spanish monarchy in a war of independence, and Philips II in those days was sort of the exact opposite. He had a reputation for not repaying his debts. In fact, I think he defaulted 6 times over the course of his reign. So the Dutch had sort of a local monopoly of safe asset suppliers. They were tapping into a new investor base, sort of an emerging upper class. Amsterdam became the world's financial sector, and there was arguably more political participation by bondholders, people who bought the debt, which of course creates the right incentives. And the yields on bonds issued by the Dutch Republic, we're going to particularly focus on the province of Holland, because we have great data for Holland. That was about 1/2 of the Dutch Republic's economy, are 150 basis points lower than those on British consols. Okay. Towards the end of the 18th century, the Netherlands ends up in a fiscal crisis. There's debt overhang and restructuring. Let me actually show you how much they borrowed. The first time I saw these numbers, I was stunned. I thought there was some sort of a mistake. So they borrowed a lot. This is book value of debt for the province of Holland, which includes Amsterdam and Rotterdam, from 1601 to 1794. And as you can tell, they borrowed more than 2.5 times the GDP of Holland prior to the Napoleonic Wars. Okay. Why they do that? Because they were constantly fighting wars. In the beginning, they were fighting a war of independence against the Spanish, and then there was lots of military conflict with Spain, with England. They had to build a huge fleet from scratch, which turns out is expensive, and so that's where all this money went. Let me show you some numbers in the last few minutes. So we're going to do the same thing. We're going to estimate convenience yields for the province of Holland by comparing their debt to debt issued by the UK. what we end up with is a measure of fiscal backing over debt of around 60%. After the Napoleonic Wars, when the Dutch they're really in a fiscal crisis throughout the 19th century. By the way, the Netherlands then is no longer a republic, but it actually became a monarchy after the Napoleonic Wars. They spent the 19th century in a crisis, and they were definitely experiencing a dramatic loss in fiscal capacity. The value of fiscal backing over debt then is around 92%. So here are the plots, which I think are much more informative. What we try to do is come up with measures of the market value of debt over GDP. We have a few observations that we can use to do that. That's the green line. On the left-hand side is the estimated market value of debt to GDP. And what you can see is that towards the end of the 18th century, investors see the writing of the wall. The writing on the wall, Dutch debt starts to trade at steep discounts, and that green line plummets towards the red line. But you do see a very similar pattern. Throughout the 17th century, the golden century, you see the Dutch being able to borrow more than what this upper bound would have us believe, and then that completely reverses itself in the 19th century, when the Dutch experience a dramatic loss in fiscal capacity, and when they lose this exorbitant privilege to the UK, obviously, because as I told you, the UK sort of takes over the baton after the Napoleonic Wars. So let me stop here and conclude. I think what you learn from looking at history is that it looks like when you get tapped to be the world's fastest supplier, you get some extra fiscal backing. Even when you account for convenience yields and all that, there's still some extra kick you get from being tapped to be the world's fastest supplier. As I said, we count for convenience yields, but that doesn't quite get us to close that gap. That gap completely disappears for the UK after the Second World War. After the Second World War, its debt is more than fully backed by surpluses. And then for the US, you see a complete reversal because they take over the baton after Bretton Woods and become the world's safe asset supplier. Before that, taking a step back, you see something quite similar for the Dutch Republic. Large convenience yields prior to the Napoleonic Wars, they issue a ton of debt. That extra fiscal capacity is withdrawn after the Napoleonic Wars when the UK takes over the baton. So what's the bottom line? Well, I think there is sort of an interesting lesson for the US today, which is that if your relative fundamentals deteriorate sufficiently, that extra fiscal capacity you get as part of the exorbitant privilege can be withdrawn. And if you look at Congressional Budget Office projections for the US, which if you haven't done that, I recommend looking at them. They're pretty dire. The Congressional Budget Office projects a debt to GDP ratio of around 190% in 2052. So that's basically what I had, and I'd be happy to take any questions if there are any. And I want to thank Christophe and the organizers again for giving me this opportunity. Thank you. Thank you for listening.
Fantastic. Right on time. Thanks so much. Fascinating. So the first question comes from Charles Engel. Charles, if you want to jump in and ask in person, I think you have the option by raising your hand. I can also read your question. I'm happy to do that, but if you want to just jump in, feel free.
Yeah, well, I mean, I can read it too, but I guess, you know, I mean, what I wrote here is how do you interpret the measure of fiscal capacity being less than the market value of debt? You've got a budget constraint and a no arbitrage condition. And, you know, it's just rewording. I mean, where do you think this exorbitant privilege, what does it mean? So are you saying the market's expectations weren't rational? Or is it possible you're saying you're mismeasuring something like expectations of future fiscal policy or something else?
Right. That's a great question, Charles. Thanks for that. You're absolutely right. So to be clear, if the market is pricing future surpluses accurately, then our measure of the upper bound on fiscal should always exceed the market value of debt. So what does this imply? Well, this implies that if you get tapped to be the world's safe asset supplier, it looks like you can have long periods of time where the market value of debt, the market's assessment of future surpluses, properly discounted, seems much higher than the answer that an econometrician who's reasonably informed would come up with. You see that for the UK in the 19th century, you see it for the US in the 20th century. We've done a lot of work on this for the US. And by the way, we're sort of being generous here, as I said, because we're computing this upper bound, right? The reality is that actually tax revenues is actually very risky, especially in the 20th century, because it plummets in high marginal utility states of the world. So if you actually do the proper valuation, not just the upper bound, you'll get even lower numbers. So what does that mean? And that's the question Charles has. Well, in finance, we're comfortable with the notion that certain classes of securities can be mispriced for a long period of time. It is entirely possible that if your IOUs play a critical role in the international financial system, there's this inelastic demand from investors who don't do the work and constantly check the intertemporal budget constraint. Now, of course, that doesn't last. Eventually, there is a reckoning. There's another interpretation, of course, and I think that's what you're getting at, Charles, which is maybe we messed up. Maybe we're just not measuring something accurately. And I think that's, of course, I mean, as an economist, you have to recognize that that's certainly possible. But I will say that we've tried hard to sort of carefully look at all possible explanations. One easy fix would be to say, well, suppose there is a high marginal utility state at some point in the future, so a bad state of the world where consumption really drops, Great Depression, and the government runs very large surpluses in those states. If a government can credibly commit to doing that, that would explain the whole thing. That's not what governments do historically, but if you believe that, that would do it, because then that would dramatically boost under the risk neutral measure that present discounted value relative to what we're computing, but it seems somewhat implausible to me. So the bottom line is, I think, you know, as a financial economist, I'm comfortable with the notion that sometimes some securities can be mispriced for a long period of time.
So let me maybe jump in there on the mispricing. So I was wondering where this, you know, or I've been intrigued for a while, where the convenience yield in the bigger picture comes from. And of course, you're making this kind of, that basically you become this fiscal space hegemon, or fiscal space superpower, right? For a while. The question is, of course, if it's mispricing, or if there's something that we economists are not good at capturing, for example, military power, the expectation that you will win the potential wars, that, you know, all those who gave you credit are basically subject to your military might. So I was just wondering how that plays in kind of the political versus the purely financial superiority of these countries, like a safe asset supplier vis-a-vis military hegemon.
So the notion that maybe these securities were overpriced from an ex-ante perspective, I'm kind of comfortable with that notion. There's some evidence to support it, though, because like if you look at real returns that I've plotted here during the First World War, ex post, right? They're really dire. So bondholders, if you bought UK gilts prior to World War I, you were taken to the cleaners, basically, right? You experience very low real returns. So I think it's reasonable to say that ex ante, before the First World War, these bondholders didn't expect that to happen, but it did, and so as a result, I'm sort of comfortable with this notion that, well, maybe if you were an investor in 1905, your assessment of future surpluses was kind of off, and you were overpricing these securities. But you raise an interesting point, Christoph, which is that this is potentially also tied together with sort of geopolitical considerations, right? And that's an interesting angle that we certainly have not pursued. People have suggested to us that maybe the reason the UK was able to borrow as much, and there was an optimistic assessment of its fiscal capacity, because it was also colonial power, and it sort of had all these other colonies that it potentially could even sell and raise revenue that way. We've looked into that. That was actually a point that was raised by Jonathan Payne when he discussed our paper. It turns out that these colonies were heavily indebted themselves, and so if you sort of do the math, it's not so clear that helps you close that gap, because these colonies and other Commonwealth countries had actually fairly high debt to GDP ratios themselves. I think I have a picture of this at the back that I could probably quickly share. Yes, so these are the numbers we came up with. So when we include colonies, the debt to GDP ratio actually ticks up a little bit. Not clear that helps a bunch. I do think there's an interesting geopolitical angle here. Obviously, there is a nexus between military power and this position of exorbitant privilege. Certainly, if you look at the Dutch Republic and the UK, but I can't say that I have much to add on that specifically. But it's an interesting point.
Great. Alberto Martin has a point.
I just had a quick comment, which was maybe one way to think about Charles' question is that there was some kind of bubble on this government debt, so that the value can exceed the net present value of surpluses. You can expect these hegemons to be able to roll it over indefinitely, and this is a privilege you might lose once you lose the hegemon status somehow, maybe. And so this is a situation of a large value of debt, like the fact of not having surpluses in expectation.
Yeah, and actually that's a great point, Alberto. I mean, there is a large literature, I should acknowledge, of that sort of sets up models, typically without long-lived investors, or without long-lived securities, where governments can sort of impute these bubbles to government debt. The reason I'm reluctant to endorse that view completely is that these models typically don't have anything to say about why it's the US, right? Why not Belgium? The model is silent on that typically. In those models, any country would be able to generate that kind of a bubble. And I also don't think these models are able to explain to us why the bubble would disappear. That's another issue, I think, a challenge for these class of models. And then the last point is that typically, actually, in these models, any long-lived asset can have a bubble, not just treasuries. Stocks can have bubbles too in most of these models, and then you have to do work to sort of create a special role for treasuries. So that's kind of why I'm a little reluctant to go along with that. And as I said earlier, I showed you evidence that ex post real returns for UK bondholders and for Dutch bondholders were dire, right? So from an ex post perspective, it certainly looks like they made a mistake.
Yeah.
They didn't come away happy. If you'd interviewed a UK bondholder in the 1920s, I think they'd tell you that they'd been too optimistic.
Yunus, you wanna come in, Yunus Aksoy?
Yeah, hi, Hanno. Hi, nice to see you. Just a clarification, actually. Just the so you referred the CIP violations as indications of the exorbitant privilege. I just kind of recall this paper by Borio that kind of computes the CIP violations as an outcome, post-2014 as an outcome of this financial actors managing their risk better, and actually also the hedging demand. So just basically, I was just wondering how does
the connection?
Exorbitant privilege evolution.
Thanks, Eunice, and it's great to hear from you. Eunice is we spent our formative years together in Leuven, so that Eunice is an old friend. So that's a great question. So the CIP violations those guys are looking at are LIBOR CIP violations, and certainly hedging pressures play a big role there, right? So for example, the idea is Japan has a large yen depositor base. They want to invest abroad to get higher returns, and that creates a lot of demand for synthetic dollars and creates a negative basis. Flip side, Australia, positive basis. What I'm talking about here is CIP violations in treasury markets, right? So not LIBOR, but treasury. So, and you know, those could be big, those bases, even when the LIBOR basis is zero. Because you're looking at treasury yields, and there could be a gap in each country between the treasury yield and LIBOR, and typically there is. And that could be different in those two countries. So you can have large violations of treasury CIP, even when in LIBOR markets, CIP holds exactly. So that's the way to connect these two. And then when you look at the US, today you typically see, although the gap's smaller at the long end than it used to be, that the synthetic yield, dollar yields are always higher than the actual dollar treasury yield, right? Another way of saying is that treasuries are expensive. And so that's one measure of the convenience yield. So I don't think there's a contradiction between these two. It's just that they're different objects. Yeah.
Perfect. Thank you so much.
Nice to hear from you.
Nice to hear from you.
Great. We have a question by Nicola Benigni.
Hi there. Thanks for the talk. One thing I was wondering is, you assume in your exercise that all the domestic, the bondholders are all domestic, whereas there may have been foreign bondholders with a different stochastic discount factor that then would give you an overall different valuation of this, and that could lead exactly then to a different picture.
Thank you, Nicola. That's an interesting point. So I wouldn't say that we assume all investors are domestic, but we certainly assume that there's one pricing kernel for these payoffs. And you're absolutely right that if markets were sort of segmented in a way, and these foreigners have a completely different SDF, that could be part of the explanation. And that's somewhat intuitive, right? If you think that foreign investors have just less elastic demand, that does mean that effectively they have a different pricing kernel, and that could be consistent with this. So that's not something we explicitly pursue here, but in our work on the US, we have a paper called the US government debt valuation puzzle. We dig into that a bit more, and I think that's potentially a promising way of thinking about it. That there are these foreign investors who, when you're tapped to be the world's safe asset supplier, come in and they just have less elastic demands. But then that demand can disappear, and that's when you end up in fiscal trouble. Yes, that's potentially a helpful way to think about this.
Okay, thank you.
Thank you.
Great. I take the advantage to ask one more question, if I may. So
sure.
Another dimension I've been quibbling on for quite a while is kind of the again, where this convenience yield, the privilege comes from. And I've looked into this historic data, and what you see is that kind of the dominant financial center of the time seems also to shape the way government bonds are structured. So whether you issue consols, whether you have sinking funds, whether you have kind of bullet bonds. So the kind of, in a way, the financial hegemon seems to shape the form all other countries in the world issue debt, right? So there seems to be kind of, if you want, a convenience, or and usually the center can issue longer bonds, right? So it's kind of a convenience maturity, if you want, or a convenience kind of plain vanilla instrument privilege that you can impose kind of debt structure on everybody else. And I've been wondering whether, you know, how much of the convenience yield is due to that, right? That they can issue differently, and that they can maybe better manage the debt, choose maturities that they're liking, and all these kind of things. But especially kind of this if you are the one setting the standards, if you want, in government debt markets worldwide, then you have this additional space. I was wondering how much that matters, because we always think about price only, right?
That's a very good point. It's one that we have not explored, but certainly you're right. When you read about the way these Dutch provinces issued debt, it was radically different from, for example, the way the Spanish monarchs financed their wars. They were really mostly borrowing from a consortium of Genovese bankers, whereas these Dutch provinces were really issuing bonds that would be bought by, you know, what we would now maybe call institutional investors, like the endowment of an orphanage in Amsterdam, for example. So you're right. They definitely innovated in how they finance the debt, and maybe even dictate things like maturity structure. That's honestly a very interesting point that I haven't explored. But I think my understanding is the data is there. So it would be very interesting to look at that and explore that, and maybe measure how much of the privilege is actually, for example, in your ability to issue longer term debt, which seems important when you go to war, for example, right? That's a very good point. And that'd be interesting to look at.
Yeah, no, I haven't seen anything on that, and in all this debate.
Yeah.
Great. So I see no further question. Time's up already. Thanks so much for presenting, to everybody for interacting, and thanks for joining so numerously. And yeah, everybody have a nice morning, lunch, evening, wherever you are.
Thank you, Christoph. Thanks to all the participants. Hanno. Thank you. This was a lot of fun. Thanks a lot.